Let me be absolutely direct with you right now, because nobody else in your life has the guts to say this to your face. The most powerful financial institutions on this planet, institutions that control trillions of dollars in reserves, that employ armies of PhD economists, that have access to intelligence and data that you will never see in your lifetime, are quietly, methodically, and urgently accumulating gold. Not Bitcoin, not tech stocks, not some leverage ETF that your broker is pushing this quarter. Gold. And they have been doing it year after year after year in increasing quantities. Now you have two choices. When you hear that information, you either pay attention and act, or you go back to scrolling your phone and wonder in 15 years why your purchasing power has been cut in half. I don't care which one you choose, but I'll tell you this. One of those choices is what wealthy people make, and one of those choices is what broke people make. The signal is blinking red. Are you awake enough to see it? Before I go any further, I need something from you, and I'm not going to be polite about asking for it. Hit the subscribe button right now. The analysis I'm about to give you is the kind of institutional-grade intelligence that private wealth managers charge thousands of dollars per year to deliver to high-net-worth clients. You are getting it here for free. That is not a gift, that is an opportunity. And opportunities have windows. Subscribe, turn on the notification bell, and let's get to work. Because what comes next is going to fundamentally change how you think about your money and your future. Now let's talk about what is actually happening in the gold market, because the numbers are not subtle and they are not open to interpretation. The World Gold Council, the organization that literally surveys central banks for a living, has been tracking a sustained multi-year trend of central bank gold accumulation that is unlike anything we have seen in modern financial history. We are not talking about a quarter or two of buying. We are talking about a strategic shift in how the most powerful reserve managers on the planet are thinking about their balance sheets. And the foundation of this entire shift rests on one critical fact that most retail investors have never even considered. Gold is recognized by the International Monetary Fund as a reserve asset. Silver is not. Let that sink in for a moment, because it matters enormously for understanding the price dynamics of both metals. When central banks diversify their reserves, they are operating within a framework of recognized, legitimized asset classes, and gold sits at the top of that list. It always has, and it always will. This is not a speculative position. This is a structural reality baked into the architecture of the global financial system itself. What this means for the gold price over the long term is something that should make every serious investor sit up straight. When you have a buyer class of this size, sovereign wealth, managers, central banks, reserve institutions, operating on a multi-decade time horizon with no pressure to sell, no quarterly earnings calls to answer to, and no retail panic to respond to, you have a permanently elevated floor of demand underneath the gold market. These are not traders. They are not momentum chasers. They are accumulators. And every single ounce they buy goes into a vault and stays there for years, often decades. The math of this is straightforward. When you remove supply from a market and replace it with a buyer that never sells, you create sustained upward pressure on price over time. That is not hope. That is arithmetic. And the arithmetic right now is pointing in one direction. The natural question, and the one that actually matters, is not whether central banks are buying gold. We have established that they are. The question is why? Because the reasons tell you something profound about the state of the global financial system. Joe Cavatoni, the senior market strategist at the World Gold Council, is one of the few people on earth who actually sits across the table from central bank reserve managers and asks them directly what they are thinking. And what they told him should make every single person watching this video deeply uncomfortable. These institutions are buying gold because of homegrown inflationary concerns, meaning they do not trust their own monetary policy to protect purchasing power. They are buying gold because they need a liquid instrument that exists outside the web of political entanglements and counterparty risks that define the modern banking system. They are buying gold because of geopolitical risk, trade disruptions, and sanctions. And perhaps most importantly of all, they are buying gold because of asset freezes, the very real and very terrifying precedent that has now been set, where sovereign assets can be frozen by another government at the stroke of a pen. Think about what that means. A central bank sitting on reserves denominated in dollars or euros now has to ask itself a question that would have seemed unthinkable 20 years ago. What happens if the nation holding our currency decides it does not like our politics? What happens if our dollar reserves are frozen overnight? The answer to that question for central bank after central bank around the world has been the same. We need gold, because gold cannot be frozen, cannot be sanctioned, and cannot be devalued by a foreign government's printing press. Over the next 5 years, these institutions are signaling a deliberate, intentional reduction in their dependency on fiat currencies, specifically the dollar and the euro, not some obscure emerging market currency, the dollar, the reserve currency of the world, the currency that every economics professor told you was the bedrock of global finance. Central banks are moving away from it, and they are moving toward gold. Now, I want you to pause for a second and connect what these trillion-dollar institutions are afraid of with what you as an individual should be afraid of. The concerns are not different in kind, they are different in scale. You are worried about inflation eating your savings. So are they. You are worried about a government that can monitor your bank account, freeze your assets, and penalize you for legal behavior it suddenly decides it does not like. So are they. The only difference is that they have already done the analysis and made the decision. Most retail investors are still on the sideline arguing about it with their golf buddies. Now I want to talk about the gold price itself, because the recent action in the market has created a great deal of noise, and most people are drawing exactly the wrong conclusions from it. Here's what actually happened. Over a period of roughly 5 months, gold ran up approximately 30% on the back of rate cut expectations, momentum trading, leveraged products flooding in from Asian markets, speculative accumulated products, and a wave of short-term money chasing a fiat-based return. That is not a fundamental rally. That is a speculative frenzy, and speculative frenzies always end the same way. When the air comes out, it comes out fast, and the 20% correction that followed was not a surprise to anyone who was paying attention to the structure of the move. What was surprising, and this is the key insight from someone who surveys central banks for a living, was not the correction. The surprise was the irrational, unsustainable nature of the 30% run-up that preceded it. Joe Cavatoni said explicitly he was surprised by the unrealistic 30% run, not by the correction. That is an important distinction that most retail investors completely missed because they were too busy panicking about the price drop. Here is how I want you to think about what happened. There are two fundamentally different camps operating in the gold market simultaneously, and they are playing completely different games. The first camp is the short-term traders, the momentum chasers, the leveraged speculators, the people trying to make a fiat-based profit in days or weeks. They drove the price up 30% in an irrational burst of excitement. And when the trade stopped working, they sold. That is what they do. That is their entire business model. The second camp is the structural accumulators, central banks, long-term investors, and the handful of retail investors smart enough to think in years rather than days. This camp does not care about a 20% correction. In fact, a 20% correction is precisely the event they have been waiting for, because it allows them to buy more at a lower price and improve the average cost of their position. These two camps will always exist in every market. The question you need to answer honestly, right now, is which camp you are in, because your answer to that question will determine your financial outcome over the next decade. If you're trading gold for short-term fiat profit, fine. That is a legitimate strategy, but understand what you are doing. If you are trying to build long-term wealth and protect purchasing power across a generational time horizon, then price dips are not a warning to sell, they are an instruction to buy. I respect people who challenge their own thinking, so let me do something that most gold advocates refuse to do. Let me present the bear case for gold honestly, completely, and without flinching. Because if you cannot honestly confront the scenario that kills your thesis, you do not have a thesis, you have a religion. So here's the bear case laid out as cleanly as I can give it to you. The scenario that genuinely threatens gold prices is a global liquidity crisis of the highest order. We are talking about oil at $120 a barrel sustained over an extended period, creating an economic emergency so severe that central banks, the very buyers propping up the gold market, are forced to liquidate their gold holdings to fund their economies. If multiple large economically significant nations simultaneously decide they need to sell gold to keep their governments operational, that selling pressure would be enormous and the price impact would be significant. That is a real scenario. It is not fantasy. It has historical precedent in smaller, isolated cases, and it cannot be dismissed. Now let me steelman that argument fully before I dismantle it, because it deserves the respect of a serious response. The scenario Joe Cavatoni is describing is not a Zimbabwe-style isolated collapse where one small country sells its gold, reserves, and it barely moves the needle on global prices. He is describing a scenario where major economies, nations with reputable, globally used currencies, face a crisis so severe that their fiat currency is no longer accepted as payment, and they're forced into gold liquidation. If that happens, yes, the gold price takes a significant hit in the short term, and yes, that is painful if you're sitting on a large position. But let me ask you something that I think cuts right to the heart of this bear case. If the dollar, the euro, and multiple major global currencies simultaneously face a crisis of confidence so severe that the nations issuing them are selling gold to fund operations, what exactly do you think happens to every other asset class in your portfolio? What happens to your equities? What happens to your bonds? What happens to your real estate, your 401 kilobits? Your savings account, denominated in the very currencies that are collapsing. The bear case for gold is simultaneously the catastrophic case for literally every other mainstream asset class. It is the scenario that wipes out everything. And in that scenario, the person who held physical gold and survived the short-term chaos is the one who emerges with purchasing power intact. That is why the host of the interview called it the buying opportunity of a lifetime. Because for anyone who can weather the storm, anyone who has planned for food, safety, energy independence, and basic operational survival, a forced gold liquidation by desperate governments is not a disaster. It is the greatest transfer of wealth in modern history, and the buyers are the ones who were prepared. I want to end on something that I think is more important than central bank data, price charts, or geopolitical analysis, and that is the psychology of why most people will never act on any of the information in this video. This is the part that most financial commentators skip because it is uncomfortable and because it requires you to look at yourself with brutal honesty. And that is exactly why I am going to spend time on it. The World Gold Council's own people have identified what they call one of the single most frustrating realities of the gold market. People are not avoiding gold because the mathematics do not work. The math is overwhelmingly in gold's favor over any serious time horizon. People are not avoiding gold because the logic is flawed. The logic is airtight. People are avoiding gold because of a tribe. Think about what that word actually means in this context. Every single one of us belongs to multiple tribes simultaneously. Family, friends, professional networks, social circles, investing communities. And inside each of those tribes, there are norms, narratives, and cultural scripts that define what is acceptable to believe, own, and advocate for. In a great many of the professional and social circles that financially successful people inhabit, gold has been branded as the investment of paranoid outsiders, conspiracy theorists, and people who do not understand how modern finance works. The narrative that gold is a barbarous relic, that it has no yield, that only tinfoil hat wearers own it. That narrative was built deliberately by institutions that profit from keeping your money in their system, and it has been extraordinarily effective. Here's what happens to a person who operates inside a tribe where that narrative is dominant. They will not buy gold, not because they have done the analysis and rejected it. They will not buy gold because they will not even allow themselves to genuinely consider it. Because to consider it seriously means risking ridicule, social exclusion, and the loss of status within a group that matters to them deeply. That is not stupidity. That is a very sophisticated social survival instinct that evolved over hundreds of thousands of years of human group dynamics. The problem is that this instinct, which served your ancestors brilliantly when surviving meant staying in the group, will absolutely destroy your financial future in a world where the information your tribe holds is wrong or outdated or deliberately manipulated by people who profit from your inaction. The financial services industry has a powerful structural incentive to keep your money in products that generate fees, commissions, and management charges. Physical gold sitting in a vault generates none of those things for a broker or a fund manager. So ask yourself, whose advice are you actually following? When someone in your professional or social network tells you that gold is silly, are they giving you objective financial analysis? or are they defending a system that pays them to defend it? I am not asking you to become a gold maximalist or to abandon every other asset class in your portfolio. I am asking you to be honest about the sources of your financial beliefs and whether those sources have your interests or their own at heart. Central banks, the most sophisticated reserve managers on the planet, have already answered that question for themselves. They looked at the data. They looked at the geopolitical landscape. They looked at the trajectory of fiat currencies, and they made a decision. They're accumulating gold at a rate not seen in generations. The question is not whether they are right. The question is whether you have the intellectual courage and the social independence to follow the math instead of the tribe. Here is where we end, and I want you to listen to this very carefully because I'm only going to say it once. You now have the same information that trillion-dollar reserve managers are acting on. You know that gold is the only IMF-recognized reserve asset outside of fiat currency. You know that central banks are reducing their dependence on the dollar and the euro over a 5-year horizon. You know that the 20% correction in gold was not a warning signal. It was a buying opportunity that the smart money recognized immediately. You know that the bear case for gold is simultaneously the catastrophic case for everything else in your portfolio. And you know that the only thing standing between you and making a rational, mathematically sound decision about your financial future is a social tribe that has been conditioned to laugh at the very asset that the world's most powerful institutions are quietly stacking in their vaults. So here's my challenge to you. Make a decision today, not next week, not after you talk to your financial advisor, who earns commissions on products that compete with gold today. Decide whether you are going to think like a central bank, long time horizon, structural accumulation, zero dependency on fiat, or whether you are going to keep doing what the average retail investor doesn't wonder in 10 years where your purchasing power went. Subscribe to this channel because this is where the uncomfortable mathematical truth lives. And start thinking in years, not days, because that is the only time horizon that actually builds wealth.